Hello again. If you joined us earlier on for the calculating revenues, costs and profit webinar, my name's Graham, tutor to you, and in this revision webinar for the next 15-20 minutes, we're going to be looking at another crucial financial topic: measuring and increasing profit. And I just again would like to start off by looking at some possible or typical exam questions that you may be asked on this topic. You may be asked to calculate the net profit margin. You may be asked to calculate return on capital. A common question on this topic is analysing or evaluating a method that a business can use to improve its current profit, or suggest alternative ways in which a business could increase its profit. You also need to know the difference between cash and profit, in particular cash flow and profit, as well as being aware of the difference between profit and profitability. So we're going to explore all those concepts in the next 15-20 minutes. I'm going to end on putting it all in the context of a real business, which is Leicesters, who make bespoke chocolate. So we can just start off looking at profit and profitability, and students often get these two concepts confused, really, and they are completely different. The profit and profitability are two different concepts. Profit is total revenue minus total costs and is measured in absolute terms. Profitability, however, measures the amount of profit the business makes in relation to the size, turnover of the business, and therefore measures how efficient the business is at generating profit. So whereas profit just looks at the amount of money the business makes, profitability looks at how much it makes in relation to the business's turnover. And how we measure profitability is through the use of the net profit margin. So let's look at the net profit margin. Net profit is simply the difference between total revenue and total costs, and the net profit margin is the percentage return made on sales. And it's a very straightforward calculation. Net profit margin is calculated by net profit divided by sales revenue times 100. Now, I mentioned in the earlier webinar, if you didn't join me in that, if you asked any calculation questions in your exam, you always must show you're working out, because that way, even if you get part of the question wrong, you may still be awarded some marks if the examiner can see any evidence of understanding in your answer. Now, even if you get asked a question on net profit margin and you can't find the figures to do the formula, write the formula down. You may be awarded some marks, depending on the mark scheme, just for showing some understanding of the formula. So don't leave an answer blank. If you can't find the figures, you couldn't say work out the net profit or find the sales revenue, write the formula down, and that way you may still be awarded some marks. So it's very important to always show you're working out and never leave a question answered. So we're just going to look at net profit margin with an actual example. This will be worth 6 marks, and a question like this has come up before in, if I remember rightly, June 2010, where students were asked to calculate the net profit margin from figures not dissimilar to this. So we've got sales revenue, we've got fixed costs, we've got packaging costs, we've got labour costs, we've got other variable costs. Why this is worth 6 marks is because not only do you have to work out the net profit, then you also have to work out the net profit margin. So there's 2 calculations there. So firstly, we're going to work out the net profit, which is 58,400 minus 50,040. That is just the total of all the variable costs. So there we've got the net profit there. So it's the total of variable costs and the fixed costs there. So total revenue minus total costs gives us a net profit of 8,360. That's the first part of the calculation. Then we're going to use that to work out the net profit margin. So 8,360 divided by the sales revenue times 100 gives us a net profit margin of 14.31%. Now, again, a lot of students can calculate that, but don't really know what that means. What does that 14.31% mean? Well, really, it means for every £1 of sales, the business generates 14p, just over 14p of net profit. So that's what that figure means, the net profit margin there. Now, we're just going to look at profitability rather than profit. We're going to use the example of 2 florists. So we've got the florist there, Florist Gump. Made a net profit of 18,000 last year. Its other competitor, its main competitor, Austin Flowers, made a yearly net profit of 22,000. Florist Gump had sales of 195,000. Austin Flowers achieved sales of 260,000. So on the first glance, it looks as though Austin Flowers generated a bigger profit. Well, it did. It generated a £4,000 more profit. However, which is the most profitable? This illustrates the two concepts. So if you look at the net profit margin of Florist Gump, it had a net profit margin of 9.23%. If we look at the net profit margin of Austin Flowers, its net profit margin was less, 8.46%. Now what that means is that actually Florist Gump is more profitable. It is more efficient at generating profit. For every £1 of sales, Florist Gump generates just over 9p of net profit, where Austin Flowers generates around about 8.5p. So that illustrates the importance of understanding the difference between profit and profitability. Florist Gump is more efficient at generating profit. So moving on now, we're going to look at return on capital. Now, return on capital looks at how much net profit is made on the capital that has been invested in the business. And this can be used to ascertain the return on any capital investment. For example, a business might decide to invest in some machinery. What returns are going to get in relation to how much it's going to cost to introduce that machinery, or invest in that machinery. And how it's calculated is as follows: return on capital equals net profit divided by the capital invested times 100. You don't need to understand capital invested as part of it. If you sit in Buzz 2, you just need to know that formula, which is the return on capital formula. It won't be provided with you in the exam. You just need to know it. So return on capital is net profit divided by the capital invested times 100. So we're just going to use a simple example. We're going to look at Florist Gump again. Made a net profit of 18,000 in 2014. Its capital was 205,000. Means it's got a return on capital of 8.78%, which basically means for every £1 invested in the business, it returns just under 9p. Now that's a useful figure for investors who may be looking at investing in a business. They're going to want to see the return they get on the investment. So it's an excellent figure for comparing different businesses to invest in. So it's a useful figure for that. That is return on capital. Now we're going to move on to for the last part of the webinar, methods of improving profit. Now, improving profit, it's a relatively common question in Buzz 2, and it requires not only a good understanding of how businesses can improve profit, but also the different functional areas. So really how the different functional areas of the business can contribute towards making a profit. Now, questions in Buzz 2 on this topic usually give a specific method to consider, and questions are usually along the lines of: do you think that the best way for business A to improve profitability is to reduce its prices? Or do you think that the business B should increase its prices by 8% to improve the level of profit? So it gives you a hook there, gives you an example or a suggestion of how the business could improve profit, and asks you to sort of evaluate whether you think that's the best method. Now, how you answer a question like this is slightly different than normal questions. Is basically you would provide an argument or a line of analysis explaining actually why that perhaps is the best way to improve profit, but then you would give an argument why perhaps it's not the best method, or an alternative method of improving profit. So actually, you think actually improving profitability might not be best to reduce the prices. It might be better to say do this. So you don't have to argue against the prices. You might say, well, actually, an alternative way of improving profit is this, and you argue that line of analysis. Then when you come to evaluate, you decide which you think is the best way to improve profit. So ultimately, to improve profit, you really either need to increase your sales revenue and or reduce your costs. Now, the exact method of improving profit will depend upon the business and the information within the case study. I'm just going to cover some sort of common ones. There are lots out there, lots of different ways a business can increase profit and profitability, but some methods include increasing or decreasing its price. Now, that will ultimately depend on the price elasticity of demand. I'm going to be holding a webinar in the next couple of weeks on that. So increasing or decreasing price will depend largely on the price elastic demand. Labour productivity, an increase in labour productivity will lead to lower labour cost per unit, which in turn will lower unit costs, increasing contribution and increasing profit. So that's another method of reducing costs. Better capacity utilization, high capacity utilization will lead to lower unit costs, which again will increase contribution, reducing the break-even point, meaning the business makes profit quicker. So lines of analysis there. Promotion, cost involved in that. However, if sales volume can be increased, that's going to increase revenue. Now, I thought we'll put all this into context really, and so I wrote this very short mini case study on a business called Lessers, founded in 1911 by two brothers. It remains one of the very few independent chocolate manufacturers in the UK who specialise in luxury chocolate and truffles and sell them at a very expensive sort of premium price. Lessers estimate that the price elasticity of demand for their chocolate is minus 0.8. And Lessers don't use retailers. They only sell their chocolate in their own shop, which is attached to the factory where they make them, or online. You can't buy them anywhere else. Some background information here that during the recession, there was a shift away from premium chocolate, but as the economy continues to recover, this segment has seen very, very strong growth. Now, one consequence of this to Lessers is, as sales have increased and demand's increased, the number of faulty products has risen from 1.2% to 3.8% in the last year, which Lessers has put down to staff working extra shifts to cope with the increase in demand. So we got some background information there. You know, a very shortened version of a Buzz2 case study, but along the same lines. And then we've got some budgeted and actual revenues and costs for 2014. So we've got some information there, some data there, which you could use to support any argument. And I'm just going to pose a question here. One of the directors believes that the best way to improve the profitability of the business is to start selling their chocolate through retailers. To what extent do you agree with this statement? And again, there was a question out very, very similar. Again in I think January 2010, very, very similar to this. So you've got some information about the business. We've got some budget and actual revenues and costs, and the students who can use that data are the ones who in that exam came out on top. So how would we answer a question such as that? Well, what we're going to look at a reason, or actually why maybe the best way to improve profitability is to start selling their chocolate through retailers. But then we're going to maybe look at an alternative way that the business can improve their profitability. Now, I just want to stay on the screen a second. If we have a look at the budget and actual, we can see that sales revenue was less than budgeted. The one that really stands out, if you have a look at that, is wages, where the budget and actual, there's a massive variance there. They spend not far from, £150,000 more on wages. Now, if we can relate that to the information in the case study, that actually we can see that there was extra shifts put on to cope with the increase in demand. So obviously that the business is paying a lot in overtime, which we can make that assumption from the actual compared to budget and from what the actual information in the case study told us. That is a good way to achieve good application. It is combining data in an exam. So if you can combine one piece of information with another and use that in an argument, that is going to get you good application and open the door to good analysis. So let's just look at a basic structure for this. So maybe a reason why selling through retailers is perhaps the best way to improve profit is obviously you're going to potentially sell more through retailers. You're going to widen your distribution, put products in danger of selling. Increased awareness. Now, if you go to a supermarket and see a box of Lessers chocolate, you might not actually buy them there and then, but you'll have seen them. So actually, it's going to increase your awareness of the product, and you might go on to make a purchase online. So even though you might not buy it through the retailer, you might see it if you're shopping in Waitrose perhaps or Tesco, and say, actually, I've seen that product. It's in your head, and you might decide to go and buy a product online. So that's some reasons why actually selling through retailers might be a good way of improving profit and profitability. But then we need to look at some of the reasons against. Well, you could argue that actually you lose some of that exclusivity, unique selling point. The fact that they're a bespoke chocolate, they're only available through their own retailer, the factory shopping online, so they may lose some of that. However, if we remember what we saw in the case study, the product price elasticity demand is inelastic. Therefore, raising the price might be a better method of improving profit, because raising the price is going to increase revenue. Overtime has resulted in wages being over budget. That's going to be a massive hit on profit. That needs to be reviewed. So you could argue actually maybe by employing more staff, which would increase wage costs, but not to the extent of the same amount as overtime, might be a better method for this business to improve profit. So it's knowing how a business can improve profit and relating that to the information in the case study. We've also got these faulty products. So maybe reducing faulty products would reduce costs and help boost profit. There's a link between the overtime and staff working extra shifts and faulty products. So you can see how actually there are other methods that this business could use to improve profit over and above selling through retailers. So once you've done that, once you've argued one reason for and one reason against, then you're going to evaluate that and decide which you think is the best method for the business to improve profit. Now I'm just going to end on this, the difference between cash and profit, which is another area that a lot of students confuse. Cash flow and profit are completely different concepts. And again, this topic has been examined twice, I believe, in Buzz 2. And the questions sort of center around whether a business should be more concerned about its cash flow position or its profit. Now, if students don't understand the difference between cash flow and profit, they're not going to be able to answer a question such as this. So knowing the difference between the two will allow you to answer a question such as that. Now, profitable businesses can run out of cash. The easiest example I used to use for my students is using a self-employed builder, I'm having a loft conversion done at the moment, so I can see this in action. A self-employed builder might take 3 months to complete a loft conversion that is going to make a profit on a customer's house, and the customer has agreed that he's going to pay after the loft conversion is completed. However, it's going to take 3 months to do. In that 3 months, the builder's going to need to buy materials. He's going to go pay his bills. He might have to pay wages, anyone working with him. However, his money, the inflow is not going to come in until 3 months, and he's got all these outflows. So therefore, there is a possibility that that builder could run out of cash. So even though that loft conversion is going to return a profit, in the 3 months it takes to build, there is the potential for the builder to run out of cash. So therefore, it illustrates the difference between cash flow and profit. Now, profitability is important with business in the long term. I mean, many businesses can survive long periods of low profitability and even periods of loss. However, not many businesses can survive cash flow problems, and it's a more significant short-term threat, and is actually one of the most common causes of business failure. So if you're asked a question on whether a business should be more concerned about cash flow or profit, in the short term, cash flow needs to be solved. Profit, it's important, but it's a more long-term issue. So hopefully that's illustrated the difference between cash and profit. And that brings us to the end of tonight's webinar. I hope you found that useful. It was a whistle-stop tour through measuring and increasing profit. For more help and advice on anything business related, follow Jim at Tutor2You, or follow myself, Tutor2You_Graham. If you're sitting Buzz2, then follow the Buzz2 hashtag. More than happy to if you follow us on Twitter, you've got any queries, please tweet us. More than happy to help out. I hope you find that useful. Check the blog in the next coming days, because we are going to be running more webinars on key topics as the exam approaches. So thank you for joining me, and good night.